It's always fascinating how the mutual fund industry sort of acts like a pulse check for the market, doesn't it?
Yeah.
It reflects how investors are feeling, almost in real time.
It really does. It
Yeah.
gives you that peek under the hood of overall market sentiment.
And today, we're diving straight into the mutual fund holding report for March 2025. We want to get a really clear snapshot of what was actually happening.
Exactly. Our mission here is basically to get a handle on the key movements, the key shifts within the mutual fund world during March.
Right.
So we're looking at where the money flowed, inflows, yes, but maybe more importantly this month, outflows, and which specific stocks saw, significant action from the big funds.
It's about seeing those underlying currents. And this report, it's packed of detail, isn't it?
Oh, absolutely. We've got the big picture, the overall industry flows. Then we can zoom in on different types of schemes, equity, debt, hybrid, all that.
And the really interesting bit, the specific stocks funds were buying and selling.
Precisely. So let's start with that big picture, the total movement of money across the whole industry in March. What did that look like?
Well, the headline number is pretty stark, isn't it?
It really is. What jumps out immediately is the dramatic swing from February. February saw a net inflow of around 0.4 lakh crore.
Okay, so money coming in.
Yes, but March,
Yeah.
a complete flip, a net outflow of 1.64 lakh crore.
Wow, okay. That's a huge turnaround, over 2 lakh crore difference month on month.
It is. It signals a pretty significant widespread shift in how investors were thinking about allocating capital during March.
So where did most of that money leave from? Let's dig into the different types of investment schemes. Which ones saw the biggest withdrawals?
The data makes it really clear. The biggest hit was in the income or debt-oriented schemes.
Right.
We're talking a net outflow of 2,002,663 crore in March. Just massive.
And how does that compare to February?
Well, that's the key context. In February, the outflow from these same debt schemes was only about 6,526 crore. Much, much smaller.
So that really raises the question, doesn't it? What drove such a huge move away from debt in just 1 month?
Exactly. It often suggests, changing expectations about interest rates, maybe concerns about inflation, or perhaps just a general reassessment of risk and fixed income.
Makes sense. And I noticed the outflows were pretty big in the really short-term liquid categories too, like liquid funds.
Precisely. Liquid funds, which are typically for parking cash very short term, saw a huge reversal. They went from a net inflow of nearly 5,000 crore in February
Okay.
to a net outflow of 1,033,034 crore in March.
That's a really dramatic shift for something usually considered quite stable.
It is, and it wasn't just confined to those general debt and liquid funds. Even gilt funds saw outflows pick up.
Ah, the ones focused on government bonds.
Yes, exactly. The net outflow there increased to 759 crore in March, up from 278 crore in February.
So while the amount isn't as huge as the debt funds overall, the trend continued, even intensified a bit.
Right. It suggests maybe a broader concern related to government debt or, again, those future interest rate movements.
Okay. What about the funds that mix things up a bit? Hybrid funds, arbitrage funds, did they follow the same pattern?
They did, largely. Hybrid schemes, the ones mixing equity and debt flipped from a 6,804 crore inflow in February to a net outflow of 947 crore in March. Quite a swing.
And arbitrage funds, they try to capture those small price differences, right?
Correct. And they also went from inflow to outflow. About 3,600 crore during February, switching to about 2,800 crore out in March.
So it seems like a fairly broad cooling off across different strategies, not just pure debt.
That's a good way to put it. Even gold ETFs, often seen as a safe haven.
Yeah, what happened there? February saw a big inflow.
It did, almost 2,000 crore. But March saw a small net outflow, about 77 crore.
Interesting. So maybe less appetite for that safety play compared to the month before.
Could be. Or maybe just profit-taking. It's hard to say definitively from just this data point. And lastly, fund-of-funds investing overseas also saw a tiny shift to outflow. Minor, but part of the overall picture.
Okay, so the dominant story is definitely outflows across many categories. But were there any areas still attracting money? Maybe equities?
Yes, and this is really important. Growth or equity-oriented schemes did still see net inflows.
Oh, Okay.
But the pace slowed down. The inflow was 25,082 crore in March, which is still substantial, but it was down from 29,303 crore in February.
So equity's still attracting cash, just not quite as much as the month before. That's a key distinction.
Absolutely. It suggests that despite the caution shown in the debt markets, investors weren't completely abandoning growth assets.
And within equities, did any particular type stand out? I saw flexi-cap funds did okay.
They did, actually. FlexCap funds, the ones that can invest across large, mid, and small caps, saw their net inflow tick up slightly, from about 5,100 crore in Feb to 5,600 crore in March.
Maybe investors like that flexibility in uncertain times.
That could be part of it, yes, allowing the fund manager more leeway to navigate.
What about some of the other, maybe more niche categories?
Well, solution-oriented schemes, think retirement funds, children's education funds, they were pretty stable. A small net inflow of 241 crore, very similar to February, consistent if modest.
Right.
But interestingly, other ETFs saw a big jump in inflows, from about 3,800 crore in Feb up to nearly 11,000 crore in March.
Wow. Any idea what might be driving that within other ETFs?
It's hard to say without more specific data, but it could be increased interest in particular indices, maybe specific sectors, or even international ETFs that fall into this bucket. It's a category worth watching.
Definitely. Okay, so a mixed bag, but the big move was clearly out of debt and liquid. Let's pivot now to the stocks themselves. Which companies were mutual funds adding significantly to their portfolios in March?
Sure. The report lists several as major additions. We've got names like Reliance Power, JSW Holdings, Orion Pro Solutions, Bratton India Power, Balu Forge Industries, PC Jeweler, Goldium International, Reflex Industries, Skipper, Lloyd's Enterprises, and Websol Energy System.
That's a really diverse list. Power, IT solutions, jewelry, industrials. What can we sort of infer from these additions?
Well, a few things potentially. It could signal growing confidence from fund managers in these specific companies, maybe their turnaround stories or future growth. Or it could be strategic sector bets. Perhaps they see value or they're positioning for trends they anticipate. It definitely makes you wonder why these particular names gained favor.
Food for thought, for sure. Now, on the flip side, which stocks saw major exits? Where were funds reducing their holdings significantly?
There's a notable list there, too. ICICI Securities is on it, Hindustan Oil Exploration, Orient Paper, Puravankara.
Okay, quite a few different sectors again.
Yeah, Balmer Lowry, Ramkey Infrastructure, Venky's India, Dish TV, Vitol Corporation, Mathan Alloys, Confidence Petroleum,
It keeps going.
Sindhu Trade Links, ESAF Small Finance Bank, Muthoot Microfin, Den Networks, India Pesticides, Odigma Consultancy Solutions, and Systematics Corporate Services. Phew.
That is a long list. What might be behind these sell-offs?
Again, multiple possibilities. It could be simple profit-taking if these stocks had a good run.
Right.
It could be a strategic shift away from certain sectors, maybe redeploying capital elsewhere. Or it could signal concerns about the future outlook for these specific companies or their industries.
I noticed a few financial services and microfinance names in there, like ICICI Securities, YASAF, Muthoot Microfin.
Yes, that's definitely noticeable. Multiple exits in that space might suggest a shift in sentiment or perhaps specific concerns related to those subsectors during March.
It really paints a picture of active management, fund managers constantly reassessing. Okay, let's touch on new fund offers, NFOs. Was there still appetite for new launches despite the overall outflow?
Yes, there was. Even in the growth equity space, 4 new schemes launched, raising about 457 crore collectively.
What kinds were they?
A mix. 1 large cap, 1 mid cap, 1 value fund, and 1 sectoral thematic fund. So still interest in specific equity strategies.
Interesting. And what about the debt side, given those huge outflows we talked about? Any new debt funds?
Surprisingly, yes. 2 new low-duration funds were launched, and they actually pulled in 928 crore.
So even with money leaving longer-term debt, there was demand for new shorter-term options.
It seems so. Perhaps investors felt safer with lower duration funds, which are generally less sensitive to interest rate changes.
And hybrid funds?
2 new ones there as well, a dynamic asset allocation fund and an equity savings fund. Together, they raised about 549 crore. So demand for those blended approaches persists too.
It sounds like the other schemes category was particularly active with NFOs, though.
Very active. There were 22 new open-ended schemes launched in that bucket.
22, wow.
Yeah, and get this, 11 of them were index funds.
Ah, the passive investing trend continues.
Seems like it. Plus 1 gold ETF, and interestingly, 10 new liquid funds.
10 new liquid funds, even with the massive outflows from existing ones.
Exactly. It's a bit counterintuitive, but maybe suggests AMCs see continued, perhaps tactical use for these, or are launching slightly different variations. It highlights the ongoing product development.
That's a great overview of the flows and stock activity. Now, the report also breaks things down by asset management company, the AMCs themselves. Can we look at a couple examples to see what that tells us?
Sure. Let's take, say, Aditya Birla Sun Life AMC. The report would show their total AUM assets under management and their equity AUM as of March end.
Right.
Now, for March itself, like many others, they probably saw a month-on-month decrease in both those numbers, reflecting those industry outflows.
Right, matching the overall trend.
But if you look at their year-on-year growth, chances are that's positive for both total and equity AUM. It shows the longer-term growth picture despite a single bad month.
Got it. And we can see their strategy, too.
Yes, you'd see their top sector holdings, maybe, for example, banking and finance, pharma, IT common themes. And you might even see specific stocks they bought or sold heavily in March.
Really granular detail. How about another one, say, Axis AMC? Similar story.
Likely similar pattern, yes. Specific AUM figures, probably that month-on-month dip, but positive year-on-year growth.
And sector holdings. Might they differ?
They might overlap. Banking and finance is often big everywhere, but the percentages could differ. Or they might favor slightly different secondary sectors based on their own research and view.
So comparing AMCs gives you a sense of their individual styles and performance within the broader trends.
Exactly. We'd see similar data for ICICI, Prudential, and others, each with its own slight variations.
So zooming back out then to the whole industry based on this aggregated data, what are the big takeaways?
Well, despite the March dip, the overall year-on-year growth in equity AUM for the industry is likely positive. The trend over 12 months has been up.
Provides context.
Right. And the report might give, say, 5-year Nifty returns to show the broader market performance investors experienced. You also get valuation indicators like average PE and PD ratios for the AMC's portfolio.
And sector trends.
We see confirmation of the importance of certain sectors, like banking and finance, which consistently appear as top holdings across many different fund houses.
Okay, this has been incredibly useful, really digging into the March 2025 numbers. Let's try and summarize the absolute key points for everyone listening.
Sounds good. So the main story from March 2025 was that significant net outflow, about 1.64 lakh crore, driven primarily by huge withdrawals from debt and liquid funds.
Right, a major shift from February.
Equity funds still saw inflows, which is important, but the pace definitely slowed down.
And lots of movement in individual stocks.
Yes, very active management, notable additions in some stocks, significant exits from others, showing portfolio adjustments were happening.
And despite the outflows, new funds, NFOs were still being launched, particularly index funds, low-duration debt, and even liquid funds.
Correct. Shows ongoing innovation and specific pockets of demand.
It's crucial, though, isn't it, to remember this is just 1 month, a snapshot in time.
Absolutely. These shifts are driven by broader economic news, global events, changing sentiment. It's complex. You need to see this data in that wider context.
We definitely encourage the listeners to think about those broader factors.
Which leads us to a final thought, perhaps. What does this big move out of perceived safety, like debt and liquid funds, combined with continued, albeit slower, interest in equities? What does that really suggest about where investor thinking and risk appetite might be heading?
And maybe more directly for listeners, based on seeing how the big institutional players shifted their money in March, are there any potential implications for your own investment approach or strategy?
Definitely something to ponder until our next deep dive.